finance a property so that you can go again, and go again, almost essentially as free money. Where can you find that pit of gold where you're literally harvesting from it again and again and again? Now, commercial property does it way better than residential because it doesn't require you for servicing. And so in this video, I'm going to share with you how you can use creative finance solutions to keep buying without having to put a lot of your own money in, but you can still end up with passive income at the end of it. My name is Helen Tarrant. I help everyday Australians become wealthy through investing in commercial property versus residential, building out a safe, effective, and reliable plan to get you from beginning to where your passive income goal is. Doesn't matter if it's $50,000, $100,000, or $250,000 or $2 million, there is a pathway and a blueprint that we'll build out for you. Click the link below to register for that free blueprint session, and let's get started. So the do's and don'ts of financing. And now this relates to commercial, but it will relate to you as a residential investor as well, leveling up to commercial, getting prepared. So this video is really suitable for you if you're getting and lining up your ducks ready to launch. Now, do's. Make sure you know where your deposit's coming from. Doesn't matter if you're pulling equity, have partially cash, selling some shares, as long as you know where your deposit's coming from to get ready for the first purchase is really important, because the first thing the bank's going to ask you is, where is your deposit coming from? How much is that deposit? And then they're going to work out how much you can buy. Now in the commercial space, it works a little bit differently. You see, if you are doing 100% finance or 105%, which means that you're actually pulling out the whole equity to borrow everything plus the 5% you need for stamp duty, then your calculations of your yield, which is your cash flow return, needs to be much higher than the yields or the cash flow returns that you would get in the city or in key locations or blue chip locations. So you need to factor that in. And whatever that return is, so to have that property totally not reliant on you, you need to do the numbers. And at Unikorn, this is what we do day in, day out, is help investors become really wealthy through investing in property. Now, know where your deposits are. Now, the key thing to this is then the bank is going to help you work out your servicing. So the next thing to do is make sure you have what they call a lease and an information memorandum. The bank is going to want to see a lease and an information memorandum. If that passes the test, then they're going to want to see the contract to make sure there's nothing hidden in there for you, right? So here is the IM. So that's what's called an information memorandum. The information memorandum actually shows you all the information about the property. Its zoning, its area, its location, whether it's a strata, freestanding, its parking, what the current tenant is, what the current tenant is paying in rent, and also what is the return in terms of the cash return, and also what is the rental increase per year as well as purchase price, right? So that gives the bank a lot of information. You need to have that key document. If not, you need to have those 3, 5, 10 elements to be able to present to the bank. The other thing is have your lease ready, right? A lot of times people are scrambling to find the lease and they find that the lease is expired, have not been renewed in terms of the option not being taken up, or it had an incentive that still hasn't been served. So that might be a rent-free, or it might be a fit-out contribution. Whatever it is, it hasn't been served yet. And banks don't really like that. They don't like anything that's messy, right? So make sure you can show them, yes, I have paid out the rent-free period, if that's what you did. Yes, I've done the fit-out for the tenant, or the previous owner did it, right? And there's nothing owing on that lease, so there's no outstanding obligations. Plus, this is the information memorandum. Now you've got your numbers, right? So that leads to number 3, not only knowing your numbers, but knowing your exit strategy. Why is that so important? Is then you know when do you refinance to leverage the property, or do you have a long-term hold? But also really important for financing is the type of finance you get, right? Now, if your broker or your bank knows you're going to hold this for 10 years, 15, 20 years, they know that they don't, right now they can give you a longer term, right? With potentially a shorter interest-free period that you're going to roll over as your tenants take up the option. Now, if you're intending to flip the property, you intended to buy, increase the lease, or intend to own or occupy, it's going to be a totally different type of loan, right? The bank's going to consider, because what happens is the use and the nature of the property changes, and as the use and the nature of the property changes, so does the obligations and the risk profile for the bank. So you need to be clear what your exit strategy is. A lot of people, it's a long-term hold, I'll eventually pay it off. No problems. The bank's happy to give you a much longer lease, shorter interest-free period that rolls over, but you might find your interest rates better. If you're going to be a flipper, you're going to flip, they're going to go, well, you know what, we're going to hit you with really high interest rate, charge all of our commissions and stuff up front, because we know we're not going to have another bite of the cherry, because in about 2 or 3 years time, or sometimes in 12 months, you're going to be selling that property. And if you're owner occupied, they're going to be thinking, can your business actually afford it? So make sure you know the exit strategies. If you're prepared with all of those 3 things, you can easily go and get your finance. Now, the key to it is look at why you're buying your property. If you're going to buy a commercial property because you want a cash flow and because you want to start growing your wealth, then one of the things to look for is a property that will go up in value but still sustain that cash flow minimum that breaks even on the loan and everything else you put into the property. So let's say that you're doing 80% finance and you're topping 20% of cash. Now your break even point might be that the property needs to return and not this need to return 6.5% in terms of yield, as in the cash flow return, for you to break even on the 80%. And then as the interest rate comes down, you might get some cash flow. But the most important thing is to know your break even number, right? As a follow on to the 3 do's, right? Know your break even number, because when you find that property, you know its break even number, you now can calculate what happens in 2, 4, 10 years time to be able to rebuild that again, right? Now, the 3 don'ts. Like, absolutely don't. Do not do these don'ts, right? Firstly, a messy lease, expire lease, tenants not paying their outgoings, the tenant might be defaulting or behind in rent, the lease has 6 months before it expires. All these things the bank don't want to see, and it will devalue your property. They won't let you to refinance against it, and they won't let you use any creative finance around it as well. And another note, I'm going to share with you how to do vendor finance right if you listen to the end of this video, right? So make sure you do keep tuning in. My name is Helen Tarrant, and I help everyday Australians become wealthy through investing in commercial property. Do book in for our upcoming free event down below as well. There's a link. But let's get back to it. Is messy leases. Bank really hate messy leases. Messy leases, they know that it's going to take you a long time to actually fix it up. Why would they spend that time invested in you when they can see they can do another deal, right? So you got to spend the time tidying up your leases, make sure all the things are coming beautiful and wonderfully bright before you move forward, right? So that's number 1. Now, the second thing is about outgoings, right? Make sure, a lot of people forget 2 things in commercial property investing. And because it comes from a residential space, you forget about it purely because you don't think it's relevant, because in residential, the tenant don't pay for a lot of the outgoings. In fact, they pay for 0 outgoings, 0, especially management fees, land tax, and things like that. Now, in commercial, a lot of your tenants do pay that, but it may be buried in different clauses of the lease. And that's not explained to you at the beginning when you do the deal, or you just simply forget about it because your property manager isn't experienced, or they simply just forgot because you think, well, I must be paying it, so I pay the bill, I don't send it on to my property manager, I never get it reimbursed. I've seen that happen time and time again. And then, of course, all of a sudden, you can't prove to the bank that the tenant pays outgoings because you've been paying all the outgoings and having offset it to the tenant, right? So there's no evidence. So the bank basically devalues the lease or what the tenant's paying you, and you don't get the valuation for you to allow to refinance. Now, thirdly, the most important thing is also that your rental increases and your cash flow projections of this property, right? So if it's got a tenant in it and you have a lease and the tenant's paying the outgoings, what the bank is looking for is that there is a cash flow coming in from the property, right? Whether the cash flow breaks even on your loan or not, that doesn't matter, but they're looking for that particular cash flow that is net, right? And that cash flow is what they work on in terms of taking it to the valuer, the valuer valuing the property and saying, hey, the property is now worth X versus what it was worth 2 years ago, simply because the market has changed, the demand has changed, and now people are willing to pay more for that particular type of property. And so for you, you have to be able to demonstrate that by having your rental increases each year. And most people forget about that because, of course, it doesn't really happen in residential. In residential, it's kind of deemed by whether your lease is a year, 18 months, 6 months, and it's a renewal, whatever it is, and then the market appraisal, right? In commercial, it happens on the anniversary, and you'd be surprised how many people actually forget about that, right? They completely forget about it, so that at the end of the day, there's nothing that they show that they've actually increased the rents, so they can't see an increase in the cash flow. So the bank is like, well, how are you going to service the extra debt, right? We're not going to rely on you. We're going to rely on the lease to service the extra debt, but show me how you can service the extra debt when you simply don't have the increase in cash flow, right? And again, so that comes back to really being vigilant with applying what's in your lease to continuously get finance. So finally, thank you for tuning in for all this time about the do's and don'ts of commercial finance and how you can get better finance is how you do vendor finance. Now, vendor finance in commercial property is very tricky at this point in the market purely because there's so much demand. It works better when the property has no demand, is really, really run down and no one actually wants it and the vendor has been trying to sell it for a long time. Now, this can happen often in properties that are vacant, in more regional areas, or properties that just fell through the cracks in the market, wasn't part of the market demand. For example, if you looked at buying shop fronts or office spaces during the COVID period, a lot of people probably will do vendor finance because simply they just don't have a buyer for it, right? Especially the larger properties that are 3 mil plus, a lot of the vendor finance is out there because there's just no one buying the property, right? Because it's too large, it's in the category where no one will buy. That's how vendor finance comes in. Now, what do you do as an investor is you see a pathway to be able to increase the value of that property so you don't have to pay back the vendor or have actual cash, right? Let's say you're buying a $5 million property and the bank is willing to lend you $3 million on that property, right? Because they know that that's worth $3 million no matter what. You have to go and get a vendor finance for $500,000. You know that you need to come up with about $300,000 or $400,000 terms of stamp duty. That's fine. That's what you do. Finally, you know that you have to engineer enough growth in the property in the next 2, 3, or 5 years, part of your vendor finance term, to be able to refinance the property so that you can actually buy that property, own it outright as a whole with no vendor finance obligations. The other really interesting thing is a lot of banks don't like vendor finance, so you might have to go with a second tier or a private lender, which means your interest rate is going to be higher. So your 3 mil, rather than the bank lending it to you at about 6.5%, may end up being 8.5% or 9%. So you've got to be able to take that hit because the property's got to be able to support it, right? All in all, right, what you need to look at in this whole scope of things is that the property itself, right, is able to deliver the cash flow to service the debt, or you have enough servicing to service the debt. But typically if you're doing vendor finance, you're trying to get the property self-service the debt. Secondly, you got to work out a plan how to pay that money back. So if it's $2 million you got to pay back over a 5-year period, you know that you've got to come up with $400K each year plus interest maybe to the vendor, right? So you got to work out an equitable way to share with the vendor. That $400K, how are you going to pay that off? Is the property got extra income? Are you planning to engineer extra income by putting in new tenants, refurbishing the property and increasing the income so you can pay it? Or alternatively, this might be that they hold for a year. Whatever the negotiation is very individual. Every vendor finance negotiation is individual, and you have to make sure that the bank is going to accept it, and often it's a private lender or a second tier bank that where one of the big fours probably won't. Then on top of that, you've got to work out how you're going to pay it back, how you're going to increase the value. So on a $5 million property, if you're doing vendor finance and they're lending you $2 million, you need to let that property be worth $7.5 million before you could get almost a full 70% LVR loan on a very solid lease that the bank is only to lend, where the lending will probably be somewhere at $4.5 to $5 million, where you could pay out the vendor in one big go. Now, in order for you to do that, you've got to come up with creative strategies, learn from the best and the experts. And just incidentally, we do have an uplift course. So again, if that's what you're looking for, click below, book in for that free strategy session, join one of our events and find out how I can help you level up to commercial property.